Okay, so I know there's been a lot of talk about the yield curve and how it's gone inverted. It's actually really important to know. When I first heard that information this morning, I knew that I had a good opportunity to short. So what I did was I went on the S&P, I bought a few puts, and then I sold it within about an hour or so from the purchase, and I made a little bit. So it's good to know when trading. It's also good to know in general. So in order to know what the yield curve is, you have to understand bonds. And bonds are essentially money an investor lends to a government or a company. So the bonds could have a maturity date of 2 years, 4 years, 6, 30 years, right? And when you lend money out to a government or a company in the form of bonds, there's a financial incentive, right? So you get a benefit, and that benefit is the interest earned or the yield. See the yield, and that is right here. So essentially, the yield curve is tracking bonds. So essentially, the Federal Reserve will increase interest rates when they think the economy can handle the increase. So I'm assuming your next question would be, why would the Fed do that? Why would the Fed increase interest rates to manipulate the bond market? Well, this is all done just so that they can curb inflation. So say, for example, the Federal Reserve just let a booming economy just continue to go up and up and up. The fear with the Federal Reserve is that inflation will just keep going up and up and up along with this booming economy. And so the Federal Reserve will up short-term interest rates. The long-term interest rates, that would be right here, get influenced by the market. Okay, so this curve is actually a positive scenario. When people start predicting doom and gloom on the economy, people are referring to a yield curve that looks something like this. So aside from the Fed changing interest rates, another influencer of this yield curve would be demand. So when an investor takes money out of their stocks and puts it into bonds, the percentage is lower. However, when we had this healthy yield curve, when I first started off with that one, the reason why the gap is huge like this, and this is considered a healthy market, is because investors have a lot of their money in stocks. So this is more attractive, right? It's kind of like, oh, not enough people are putting money in 10, 30-year bonds, so let's increase the rate. The rate is increased, so it makes it attractive to get into it, but people are focused on the stock market at this point, okay? And the reason why people tend to freak out about all this is because every time the yield curve is inverted like this, it correlates to a recession or a downward market. A good way to remember this is when long-term bonds have low yield, more people are focused on bonds. When long-term bonds have a higher yield, then most people tend to focus on the stock market. So the yield curve is actually a very strong indicator on whether the markets are doing good, whether the economy is doing good. There's a lot of debate obviously surrounding it, as most indicators tend to have each side. But yeah, that's all I got for you today. I hope I worded this good for you guys. I wanted to prepare it, make it look nice. So please feel free to put a like on that video and subscribe. Thank you very much.
Up.